Welcome everyone. This is the Life.Guru. Today, the topic that we have chosen is fixed versus flexible exchange rate. We'll basically cover some foundational aspects of the exchange rate mechanisms that exist around the world. So, let's quickly run through the presentation. Let us start with the basic questions. What is an exchange rate? So, an exchange rate basically means that I am exchanging one currency for another, a domestic currency for a foreign currency, at a certain rate, right? So that is basically an exchange rate. But then there are two mechanisms of basic mechanism of exchange rate. One is a fixed exchange rate mechanism, the other is a flexible exchange rate. In a fixed exchange rate, you basically say that INR, say for today it's around 75 to a dollar. That will be the rate today, tomorrow, day after, and for the foreseeable future. Flexible exchange rate, on the other hand, is determined by demand and supply. One minute. Demand and supply uh, will determine the exchange rate. So the market forces, like any commodity, say apples, oranges, the price is determined by market forces. Similarly, in the case of exchange rate, depending on how much demand is there for the dollar in the market, how much supply is there for the rupee in the market, the market forces will determine the value of the rupee vis-a-vis a dollar, as well as with various other currencies. So, but the question then arises is why? Why do we require, or in a sense prefer, flexible exchange rate? Countries all over are moving towards flexible exchange rate, and this has been the trend, uh, especially in the 21st century. The flexible exchange rate mechanism started mainly in 1973 after the Bretton Woods system collapsed, and there were various benefits that were seen in a flexible exchange rate mechanism. So the main benefit that uh, is driven from adopting a flexible exchange rate is that the economy of the country gets monetary policy independence. Now, this is very crucial, especially if there are foreign disturbances and there is monetary transmission from overseas. A fixed exchange rate, on the other hand, does have the benefit of anchoring inflation, or very high inflation, and this is especially beneficial for economies that are not known to have very good domestic policies, whether those be fiscal policies or those be monetary policies. In today's day and age, when there are more likely foreign disturbances, flexible exchange rate has become a more prominent form of exchange rate mechanism the world over. In India, uh, we have adopted the flexible exchange rate uh, fully from 1993, uh, but we have a managed floating rate, or managed flexible exchange rate. What does that mean? That means that there is some portion of central bank intervention in the market. So in a fixed exchange rate, if the central bank says I will maintain it as 75 to a dollar, if there are dollars flowing into the economy, it will buy those dollars so that the demand does not exceed the supply. In a flexible exchange rate, central bank does not intervene completely, but suddenly from 75 it jumps to 70. It will intervene and to stabilize the currency to a level that it seems acceptable. And that is why when you see that rupee depreciates from say 60 to 70, RBI will intervene in the market and bring some stability to the movement of the currency. That is a more managed floating exchange rate adopted in many developing economies. So I think the basics are covered. Go to the next slide. So an important concept is the impossible trinity. The theoretical foundations were laid by Mundell and Fleming in 1962 and 1963. Uh, the framework basically tells us that the macroeconomic objectives of free capital mobility, fixed exchange rate, and independent monetary policy, all three cannot be achieved at the same time. An economy can only opt for two of those three at the same time. So, for example, USA we have it has free capital mobility and it has independent monetary policy, right? But it has a fixed exchange rate dollar. It has a reserve currency, so it need not worry about the exchange rate mechanism. China, on the other hand, has independent monetary policy and a fixed exchange rate, but it has severe restrictions on capital mobility. So, the free capital mobility in the Chinese case is certainly not to an extent that is there witnessed in developed economies. If you look at Hong Kong, it definitely has free capital mobility, right? So free capital mobility is there. It has fixed exchange rate because it derives the value of the yuan, the CNH from the Chinese mainland central bank policies. But then it loses its monetary policy because the Chinese central bank dictates what Hong Kong will endure in terms of money supply, in terms of interest rates. So there is this fundamental framework is what drives macroeconomics and what drives central banks and fiscal authorities to adopt policies when large scale uh, policy adjustments are required. Let's come to an example of why the three macroeconomic objectives that we just discussed cannot be achieved at the same time. That is capital flows, capital mobility, independent monetary policy, and a fixed exchange rate. So, like I said, the theoretical foundations are laid down by the two papers, one in 1962 of Fleming and 1963 by Mundell. Both the papers links will be given in the description, so if anybody wants to have a look, they can go through that. Now, just to give you an example why all these three economic objectives cannot be met, let's take an example where there is inflation in the economy. So the government obviously looks at reducing money supply and increasing interest rates. Uh, so why increase in interest rates leads to reduction in inflation is another topic, and we can have a separate discussion on that. But let's just say that money supply is reduced by sale of government securities. What is the impact? The impact is that interest rates go up in India. What does that do? If interest rates in India are higher than suppose in USA, money will flow from USA to India, and this will increase inflows into India. Now obviously this is a fixed exchange rate scenario, so the central bank will try to maintain the same exchange rate. Now dollars are flowing into the Indian market and rupee can appreciate from say 75 to 74 or even more. So central bank needs to intervene to maintain 75 to a dollar because it is a fixed exchange rate mechanism that is being adopted. Now Once central bank intervenes and it buys the excess dollars that have come into the market, what will happen? The forex reserves will increase. It buys dollars and it sells rupees, because that is the transaction that it has to undertake. It has to give something to buy those dollars. This increases the money supply, and then it reduces the interest rate. Quite the opposite effect that it initially started with. So what happens? The inflation that you were trying to control has not been controlled. You are back to the same money supply levels and the same interest rate levels. And suppose you do sterilize that by again sale of government securities and again increase of interest rate, consequent increase of interest rate, the same process flow will again be repeated, and you will have no control over setting of interest rates in an economy. That is what happens in a fixed exchange rate scenario, that if you adopt a fixed exchange rate, you lose control over monetary policy, or you cannot have independent monetary policy. So let's come to the case of India. Obviously we don't have a fixed exchange rate, we have a flexible exchange rate, right? So let's look at the same example where the government is, or sorry, the central bank is trying to control inflation. It is selling government securities, reducing money supply, and it is leading to an increase in interest rates in India. Same thing will happen. Let's take again example of US economy, because that is the center economy as far as India is concerned. So increase in flows will happen to India. um, Obviously flows are happening into India, dollar flows are coming in, so there is demand for the Indian currency. The exchange rate will appreciate, it will go from say 75, it can go to say 74. In the previous example, because the money supply was reverted, there will be no impact on the Indian economy. But here, because uh, you have because but in this example, because you have reduced money supply that is not being reversed, uh, one will have a reduction in employment, a contractionary impact. Inflation will be reduced, which was the intended target. And obviously when you are contracting, you are having a contractionary monetary policy, it has an adverse impact on output, which will reduce the output, and this in a sense is an intended consequence, in the sense that there can be overheating of economy and you actually want to reduce a bit of output and control the inflation. You will also have worsened balance of trade, because current account plus capital account flows are coming in. There is this appreciation of the Indian rupee, which worsens the balance of trade. So obviously in this case what we are saying is that money supply is not being reverted. You have more control over what you want to achieve in terms of employment, inflation, etc. So your monetary policy is independent. The adjustment is happening at the exchange rate. It is appreciating in the reverse mechanism, where the central bank does purchase of government securities, increases money supply, which leads to reduction of interest rates. You will have the opposite impact, and again monetary policy will be independent. So this effect is maximized at perfect capital mobility. More the capital mobility, more the flows, more the impact to the economy. But the essence of the argument is here again, because there is a flexible exchange rate, you could have monetary policy independence. So the exchange rate mechanism is crucial in maintaining or according monetary policy independence to an economy. But let us come to recent literature that has also brought in an additional dimension where the case for dilemma is there. We discussed the trilemma, where we said that of the three macroeconomic objectives, there is a trilemma going on. You cannot achieve all three. Uh, but recent literature by Ellen Ray in 2013 and certain other economists have pointed out that even in a flexible exchange rate, monetary policy independence may not be fully maintained if it is not accompanied by certain macroprudential policies or capital controls. So let's go through this example and then we'll wrap this video. So let's take a case of expansionary monetary policy in USA. Uh, Expansionary monetary policy basically means you reduce interest rates so that it has an expansionary impact on the economy and the economy expands. So what we are looking at is when US does that, does it also lead to expansionary monetary policy in India, which would imply that India does not have independent monetary policy and is dictated by its policies are dictated by the monetary policy in USA. So suppose USA decreases interest rates, what will that happen? Again, there is interest rates in India are higher, so there is more money to be made over here. So again, flows will happen, increase to India. Again, the same mechanism as we discussed in the previous slide. Exchange rate will again appreciate. But now there are two channels through which Indian economy, uh, the GDP will increase due to influences of these two channels. One is the credit channel. This basically comes through companies having foreign debt. So I may have a $1 billion loan. I am a company residing in India, doing some business in India. But when flows come in and rupee appreciates from 75 to 74, instead of 75 billion rupees that I had to make a payment to the US company, I now need to make only 74 billion uh, rupees. So I am having suddenly a profit of 1 billion rupees just because the rupee has appreciated due to the capital inflows. This is the balance sheet effect for residents who are having lot of foreign currency liabilities. The risk taking channel also gets influenced by, because there is a relaxed VAR for lenders, there is relaxed value at risk. What this also implies is that since there are capital flows, there is a lot of liquidity. One, the overseas lender also, the market value of their investments goes up, so they are able to lend more uh, to uh, to all entities across the globe, including in India. So the risk-taking channel is relaxed. So it enables more lending and it enables an expansionary uh, outlook and output in various economies, and this basically also will lead to increased output in India. So what does this mean? This means that we did not do anything. Did the central bank in India buy or sell government securities? No. Okay, it did not do that. But did it have the same effect that we discussed in the previous slide, where we said that in a flexible exchange rate, when uh, suppose we take the opposite example of the previous slide where there is expansionary monetary policy and you buy government securities and reduction in interest rate happens, then obviously output will increase. but the central bank did not do these things, right? This was not there, but still we had an expansionary impact where the output went up. So basically monetary policy is getting exported. So how do you still maintain an independent monetary policy? By having some capital controls or macroprudential policies, and the effectiveness will be maximized at, again, capital mobility. uh, when it is much more capital mobility is there, then it gets maximized, and then hence there is more need of capital controls or macroprudential policies. So that's all. This was just a primer, basic overview of fixed exchange rate, flexible exchange rate, and the dynamics with monetary policy, and how macroeconomics works at the international level. So hope you enjoyed that, and we'll try and come out with many more lucid and short videos on various topics that may of interest. Please do comment and let us know how it was, and any specific topic that you would like us to go into more depth. Thank you.